You are listening to Keystone's Stock Talk Show, episode 287.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again this week. I am live from the Money Show in beautiful Las Vegas in a less than beautiful room. Hopefully my internet holds up here. Brennan's going to kick off the show this week with his investor spotlight on billionaire American investor, hedge fund manager, author, and founder of Bridgewater Associates, Ray Dalio. In our Your Stock Our Take segment, I will tackle a viewer question on SSC Security Services Corp, symbol SECU on the TSX. The largest publicly traded security company with a cash-rich balance sheet. It's debt-free and pays a solid 4.58% dividend. The listener asks us our thoughts on this microcap security consolidator and whether it is a buy, sell, or hold at present. Aaron answers a viewer question on Constellation Software, symbol CSU on the TSX, a massive Canadian tech success story. The company acquires, manages, and grows vertical market software businesses across diverse industries. Impressively, Constellation has acquired over 500 software companies since its inception in 1995. Aaron will give you his take on this long-term capital compounder. Finally, in our Your Stock Art, or our Stars and Dogs segment, Brett, star of the week is BigBear.ai, holding symbol BBAI, on the New York Stock Exchange, which offers AI solutions targeted at three segments: global supply chain, logistics, autonomous systems, and cybersecurity. The stock is up 304% over the past year. Brett's dog of the week is Foraco International SA, symbol FAR on the TSX, a drilling services company operating in 22 countries across 5 continents. In a positive environment for commodities generally, stock is down 20% over the past year. Brett lets you know why. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Very good, very good. And how about you? How's the weather down there in Vegas?
Well, I flew in last night, came in super late, but this morning, I think it's supposed to be up to about 19, but it was only like 8 degrees, 6 degrees last night.
So it was,
yeah, it was, I'm just going right to the pool right after this. That's all I do here, right?
It's minus 27 right now in Saskatoon, and like this morning, my dad was saying that it was minus 35. She's
for the love of God.
Yeah.
What are you doing there?
No doubt.
All right, but you guys are good.
You betcha.
I'll see you in a few days. So our poll question. We just came back. You guys, we saw you guys, Brett and Brennan. Brett is in Calgary and Brennan is in Saskatoon, and they were in town over the past week or 10 days, whatever it is now, at the World Outlook Conference. So we saw each other in person. We had our fill of each other, and now it's good to be remote, isn't it?
No doubt. A day and a half is pretty much all we can handle.
That's the limit.
Right there.
Yeah.
So let's get to the poll question. Brett, you're going to handle this.
Yeah, so the poll question this week, as we are living in really, I would say, more volatile times than what it was a few months ago, is which of the following commodities do you think will perform the best? Gold came in at 56% of our viewers' answers, oil at 18%, copper at 16%, and then uranium at 11%. And as well, I will note that we did have a comment asking about silver, which, if you want to throw that in the gold, the precious metals as well.
For some reason, the poll won't allow us to do more than 4. It's very
It will not let us do more than 4. Yes.
I know.
And
we
if
wanted
you
to put
added
something
silver
silly
in,
there.
then we would have got complaints about that. So,
It's
so
true.
what did you guys vote? I voted gold.
Me too. Yeah.
Yeah, I
just with
I
like
think
everything that's going on, like the tariff threat, potential threat for, further inflation, just kind of The uncertainty. That's kind of where.
Yeah, I think the uncertainty. I mean, typically, although we have seen times in the past where there have been uncertain periods, and you would have expected that gold would have appreciated, and it doesn't necessarily always correlate with uncertainty, but quite often it does, and that's a lot of the idea behind gold is the alternative to the paper currency, right?
Yeah, you don't see that lockstep, and even with the other gold really narrative is always around inflation. You don't ever see the inflation and gold moving in lockstep. There's some sort of lag, if you want to say there is a correlation. And then the same thing, really, I would say with uncertainty, it's not one-to-one. And uncertainty is, of course, even more subjective than inflation. So it's even harder to say if the uncertainty goes up, should gold go up? But obviously right now it is quite strong.
Excellent. Well, let's get right to it. Brennan, you're going to kick off the show. You wanted to talk about Ray Dalio.
So I recently watched a video on YouTube by Ray Dalio on essentially the rise and fall of empires. And it's based on his book called Principles for Dealing with the Changing World Order. And really the video is, an extended ad for his book. But the book essentially looks at the cycles of nations over the past 5 centuries in an attempt to make sense of the evolution or cycle of nations and global economics. And for my statistics nerds out there, he uses a multi-factor model to explain the relative power of a country in relation to its peak, focusing on 8 variables, including education, technology, competitiveness in global markets, economic output, share of world trade, military strength, power of financial center for capital markets, and last being strength of their currency as a reserve currency. Now, I'm not sure how he is exactly measuring and quantifying each metric or variable here, but I assume that he does cover this in his book in more detail. But just keep this in mind if you do end up watching the video. But using this multi-factor model, he plots out the power of the great empires going back to about 1500, as shown in a snapshot here from his video. And being a history buff, I really enjoyed the about hour-long video, and it raised me to question, who is this Ray Dalio guy, and why should I take anything that he has to say about economics and the rise and fall of empires? So I thought that I would do an investor spotlight segment on him to get an idea of who and what kind of investor he is. So to give a quick rundown on his life here, Ray was born in 1949 in New York and graduated with a finance degree from the Long Island University in 1971. And Ray's early life has actually like an interesting parallel to Peter Lynch's, as just like Peter, Ray actually caddied at a golf course where he met many Wall Street veterans, which eventually got him more interested in investing and helped him get a job at one of their trading firms. So the moral is, if you want to manage a successful investment fund, the fast track is to become a caddy at your local golf course. Obviously, I'm just kidding. But I thought that it is kind of a funny parallel that both of them did this and it got them into investing. Now, Ray considers himself to be a global macro investor, meaning he invests around economic trends such as changes in exchange rates, inflation, and GDP growth, mainly focusing on currency and fixed income markets. Now, in 1975, Ray founded the hedge fund Bridgewater Associates in his 2-bedroom apartment in New York and has served as the co-chief investment officer since 1985. And Bridgewater has become one of the largest hedge funds in the world with, I believe, about $124 billion under management as of April 2024. And he's also an author of several books, but just to touch on a couple here, his second ever book was called Principles, which was published in 2017 and focuses on his investment philosophy. And his most recent book is the one I briefly mentioned before, which is called Principles for Dealing with the Changing World Order, and was published in 2021. And again, focuses on looking at the factors of long-term empire and economic cycles. Now, Bridgewater Associates has 3 different hedge fund strategies, essentially, or funds. Its first was Pure Alpha Fund. This is its flagship fund created in 1989, and it invests across a diverse set of asset classes, including bonds, currencies, stock indexes, and commodities. And this has been closed to outside investment since 2006. And since 2005, it is reported that the annualized return has been about 4.5%. So it has been underperforming the S&P 500. Now, his second is the All Weather Fund, which was launched in 1996. And after 2008, there was a little bit of a shift in the strategy, which focuses more now on inflation-linked bonds, T-bills, and bonds, and gold. And his Pure Alpha Major Markets Fund, which was started in 2011. And this is similar to the Pure Alpha Fund with more advanced liquidity for European bonds. Now, I looked up Bridgewater Associates 13F filing, and they own hundreds of companies and several ETFs. Now, keep in mind, this is just showing their equity holdings and does not disclose, any of their currency overlay or fixed income investments. But I'll just scroll through the 13F a little bit here just to show you what it looks like. So you can see here, there's hundreds of companies. They've got 217 million in advanced microdynamics, 685 million in Alphabet, and the list really goes on and on. But I really wanted to show that, there's tons and tons and tons of stocks. But if we look, he does have a significant holding in, the S&P 500 ETF, about 1.2 billion here. And he also has about 4.8 billion in the Spider S&P 500 ETF. So realistically, this is what we would call, over diversification, in our opinion. You could really list any stock to me, any big US stock, and I'm sure that he owns it in some piece here. But yeah, I just wanted to quickly go over that there to show. Now, finally here, just to leave you with a Ray Dalio quote. He says, "Get rid of irrelevant details so that the essential things and the relationships between them stand out. As the saying goes, any damn fool can make it complex. It takes a genius to make it simple." And really, I kind of wanted to just take it full circle with, what we look at. This simplicity and focusing on the relevant relationships reminds me of, the stat that we have referenced time and time again on the podcast by Jenga Partners, which indicates that all stocks that gained 10x or 1,000% plus globally between 2012 to 2022 had, the following commonalities that are driving share price returns. 87% of all global equities that went up 1,000% or more over the past 10 years started as micro or small caps. Again, 82% of those were profitable at the start of their ascent. 91% had some history of profitability. So I guess the thing here is that I'm just getting at, I like this quote that he has, get rid of, the noise and focus on what drives stock price returns. And yeah, that's my segment on Ray Dalio. I don't know if you can really take his book, perfectly in that, what he's saying and about like the downfall of empires and whatnot. I think that it would be an interesting read. I was saying to the guys on the podcast previously that I'd like to get my hands on the book to really look into, the variables that and how he's calculating the variables and whatnot. But it was interesting looking deeper into him.
Yeah. I would say I like the quote.
Comment. Sorry, go ahead, Ryan.
Well, I was going to say I like the quote. I don't, when you went through that portfolio, not a ton of conviction.
No.
And then,
Ryan just made the exact same comment that I.
Sorry. Yeah.
No. I'm saying that just because it makes sense. That's also what I thought. Yeah.
I mean, the quote sounds great, and I think that's a great quote. And then you look at the investing versus say Warren Buffett, who there's such a, he makes a great idea count. Like that's what he does, and I think that's allowed him to profit long term. Obviously, Ray has done well for himself. Has he done well for clients long term? I mean, you went through those returns.
That's another thing. It seems that getting the returns isn't simple either. So.
Yeah, like I said, since 2005,
it's not as simple as it should be just to even understand what the. Sorry, Brendan.
Yeah, I was just saying, since 2005, his flagship fund, compound or an annualized return 4.5%.
Yeah, I mean,
not great. And I even was looking at articles, there was a flock of capital pulling out, I believe, in 2023. I believe. Don't quote me on that exactly, but he's definitely been under scrutiny recently just due to the underperformance.
Awesome.
Yeah, I don't know. I will say, I think he might have. I don't know if he's not running the fund in the same capacity since 2017. I think that's when he stepped down, or if he just took a backseat role.
That is correct.
But
Yeah, he's taken a backseat role. And like, I think that's like another concern where we're kind of seeing this like flock of capital leave is, who's going to be at the reins, and, can they, it's key person risk essentially, when all of a sudden Ray leaves essentially. But anyways, yeah, I thought it was a cool little segment just to kind of dig in and, kind of look through his, the 13F there to see what he holds. But exactly, like, I think maybe I could be wrong, but like maybe his conviction does come more with, again, the currencies and fixed income. But like, I don't have access to looking at that. But like, when we look at like equities, exactly like these guys were saying, it doesn't really align perfectly with his quote there. When you're just holding the market time and time again, or like, he's hundreds and hundreds of stocks.
Yeah. Yeah, and we always talk about how you can have a well-diversified portfolio with 20 stocks. So I'm not sure why it's necessary. And then you can have some conviction. And if you do get a great company in there, a couple great companies that can power your portfolio, and that's kind of the philosophy we've used for decades now. All right, let's move on to our Your Stock, Our Take segment. I am going to look at SECU Security Services Corp, and that is symbol SECU on the TSX. This company is the largest publicly traded security company in Canada. It is debt-free, cash-rich. They have about 3,000 employees across the country. The company provides physical security, so that would be 85 to 90% of the business. Electronic security, about 5%. Cyber security, about 5%. Services to corporate and public sector clients via two wholly owned subsidiaries. That would be SRG and Logix. SSC Security was previously known as Input Capital Corp, which was founded in 2011 as an agricultural commodity streaming company, providing several flexible and competitive forms of financing, which helped Western Canadian farmers solve working capital mortgage finance and canola marketing challenges, and improve their financial positions of their farms. On February 1st, 2021, Input acquired SRG Security Resource Group as a platform for growth in the cyber and physical security business in Canada. On September 14th, 2021, Input announced that the company would change its name from Input Capital to SSC Security Services and consolidate its common shares. Today, SSC Securities' agricultural commodity streaming business is known as its legacy business and consists of agricultural real estate assets held for sale, including farmland mortgages. The legacy business book is shrinking rapidly due to farmer buyouts via refinancing. The company is collecting accounts and making slow but steady progress, turning assets to cash, working through the legal system. As SSC Security continues to wind down its remaining legacy assets, we expect that those cash flows can be allocated to legacy, we expect that those cash flows allocated to legacy assets would be reallocated to the security services portion of the business. Now, I reviewed this business here after we interviewed management near the start of 2024. The stock has basically been flat over the course of the past 52 weeks. It was then trading around 275. It's around 262 today. Why has it been flat? Well, recent quarterly numbers basically here, as we can see, are down across the board outside of improving gross market margins. The decrease in revenue was primarily due to higher temporary contracts in the prior period. These temporary short-term contracts can fluctuate from one period to another, but management states that long-term recurring monthly revenues do remain strong. Gross profit increased to about $5 million. That would be 17.1% of revenue from 4.9 or 15.7% of revenue during the same quarter last year. The year-over-year increase in gross margin is a result of the company's continued focus on higher operational efficiencies and cost savings initiatives. The loss for the quarter was about $100,000 or about 1 cent per share, compared to a comprehensive net income in the same period last year of about $100,000, just above or just below that, just about flat per share, about break even. Now, the growth plans of the security business here. Well, the security business is a highly fragmented industry in Canada. According to StatsCan, there are over 2,700 companies providing some kind of physical security services in Canada. Many of these are small owner-operated businesses with a tier of mid-sized and larger companies as well. There's an opportunity here to use the company's balance sheet to grow into a solid, well-capitalized, profitable, and growing security platform. The strategy is to deploy the company's cash balance through its balance sheet in a growth via acquisition and organic growth opportunities in the physical and cybersecurity industries, along with adjacent verticals. The target here, and this was from management, is about 200 to 300 million in annual revenues over the next 2 to 4 years. This is from our interview with management this time last year. 1 year has passed, and the revenues in the latest period are slightly lower. So the company appears to have not really made a dent in that target. Of course, a meaningful acquisition can change that. So what do we like about this company? It has a strong net cash balance sheet as at Q1 fiscal 2025. Cash and cash equivalents were about 11.4 million. That equates to about 62 cents per share, and there's no debt. Working capital is about 26.3 million, and again, there is no long-term debt. There's high insider ownership. We like that as well. As at December 31st, 2024, management, directors, and employees own about 38% of the company's outstanding shares. Strong share buybacks over the past 8 fiscal years. The company has bought back and canceled roughly 47% of its outstanding shares. Management currently believes that the company's shares are trading in a price range which does not adequately reflect their value, and that the purchase of additional shares under their NCIB will enhance shareholder value in general. So what we don't like about the business now, low margin business. Q1 fiscal year 2025 adjusted EBITDA margin was a scant 4.01%. Management has stated the business should progress to about 5% EBITDA margin range near term, and it has potential to move slightly higher over the long term. What else we don't like is the lack of organic growth in the business, or any growth in recent quarters. No inorganic or organic growth. And inorganic would be coming from acquisitions. There hasn't been a significant acquisition in quite some time. So let's look at the revenues for this company. Revenues decreased about 5.5% to 29.1 million in the latest period. That was down from 30.9 million. In the absence of acquisitions, growth appears to be challenged. Let's look at the valuations here. SSC currently trades with a trailing 12-month EV to EBITDA of 7.69, price to sales of 0.41, which seem relatively low, but the company's price to adjusted net income based on their own adjustments is 29.1 on a trailing 12-month basis. My conclusion here, at first glance, the company is an intriguing, albeit low margin business that holds a strong cash balance, strong balance sheet. 21% of its market cap is in cash, and the company continues to convert its legacy business assets into cash. The company's cash balance should help SSC make further potential accretive acquisitions. However, the lack of organic growth near term and the margin profile are significant concerns. As I stated, the company's Q3 fiscal year 2025 adjusted EBITDA margin was around 4%. Management has stated they'd like to get that to 5% in the near term, and has the potential to move higher than that slightly. But that is a very low margin, and it is something that we're not opposed to investing in high quality, lower margin businesses if they check off a number of the boxes that we're looking for, say no debt, cash rich, low valuations, and appear to have above average growth. So SSC checks off some of those boxes, but we do not see in the company's trailing 12-month valuations overtly low valuations, and its PE remains elevated. The current margin profile, again, is just too low. Combine that with a lack of organic or acquisition growth, and the stock is not investable for us in the near term. If we saw an improved margin profile, cash accumulation, organic growth, pickup, an element we like to see in our GARP model, then we might look at the company. But the lack of execution in terms of acquisitions and organic growth over the past year leaves this company just as a company we would monitor right now.
Yeah.
And that is that.
And one thing, I mean, when we're
Live
looking
from
at these
Vegas.
businesses, when Ryan talks about organic growth, that's really a sign of the health and the opportunity just in the existing business. A lot of times companies that are focused on acquisitions will kind of cover up some weaknesses in their own existing operations by just adding new assets on. So organic growth is always an important factor to consider as well.
And the other thing on that is they've obviously done a ton of share buybacks. It was 40% over 8 years. And if they can't reinvest in their own business, that's what you end up doing is you buy back shares or you do dividend because that organic growth rate isn't there. You can't reinvest in yourself. So you distribute.
Yeah. I mean, there are parts of what they're doing that seem very interesting, but again, not margin profile. We think low margin is 10 and under, and this is like less than half of that. So yeah, it is quite razor thin in terms of margins, but interesting. All right, let's move on.
Can I touch on it?
Yeah. Oh, you want to talk?
Yeah, I just wanted to touch on it a little bit.
I don't know.
How dare you? But yeah, so we looked at SSC at the same time that we were looking at Avante Corp, or it used to be called Avante Logix, but they were selling, they sold Logix security to SSC. And, like we were looking at both of the companies at the time. And the thought was with Avante Corp, now that they've sold off this lower margin side of the business that had gross margins of, I believe, about 20%, where the rest of their business had about 40% gross margins, we would see margins uptick, generally. And I'll just share my screen here, just looking at, again, this is Avante Corp's financials here quarterly. We have seen some good growth. But the company's still, struggling to, produce net income. And like, even if we just look at like the first 2 quarters of the first half of the year here, I've calculated adjusted EBITDA margin, again, 4.4%. We had spoke with management. They were looking at, potentially, targeting a little bit longer term net income margins of 15%. But, we're really not seeing that take place here. But again, companies obviously we're continuing to monitor. But it is, like Ryan said, it's the margin profile with these businesses. And I mean, Avante Corp, the stock price has done quite well this year. But we would really like to see those margins improve.
Yeah, and it is a powerful, can have a powerful effect on the stock price if you have an increase in margins and you have growth in the business. Mm-hmm. Those two things combined, really can ratchet up earnings or cash flow per share. And so that's why we're interviewing that company, because if that plan came to fruition, it just doesn't seem to be executing on the plan. And we write these things down, we revisit, and if you're not executing, you're kind of getting an X instead of a check. If it starts to happen, then we get more interested in the company.
Yeah.
All right. I believe Aaron has a Your Stock, Our Take segment on Constellation Software, a tremendous Canadian success story, capital compounding business. Aaron, take it away.
Excellent. Okay. Well, thanks a lot, Ryan. So Constellation Software, as Ryan said, is a company that has nearly an unparalleled, or perhaps an unparalleled track record in the Canadian tech scene. So it's been around for a long time. We've looked at it many times in the past, but what really motivates me to take a look at it today as a Your Stock, Our Take is when we were just at the World Outlook Conference. I spoke to one of our podcast viewers there, and he asked that we cover the company. I can't remember who it was, but because I talked to a lot of people that day, but I do remember my promise to take a look at it. So that's what we're going to do. Constellation Software, trading on the TSX stock exchange under the symbol CSU, almost a $5,000 stock price, so very high stock price value. 100 billion market cap company. So this is one of the largest companies in Canada, and just a little tiny yield, almost insignificant at 0.12%. So what does the company do? They acquire, manage, and grow vertical market software businesses across diverse industries. So since the company was founded in 1995, they've completed over 500 acquisitions of software companies. Now, the company's stock price performance has been outstanding, both recently and over the long term. So if we just look over the past 12 months, a Constellation stock price has been up 33%. And this has been a pretty consistent return for the company over the last 10 years, 35% compound average return over this period of time. So very successful growth. Now, if we look at the company, essentially what they do, they're very acquisition focused. So they buy small to mid-sized software companies, and then they roll that into their business. My understanding is that these companies largely operate as individual entities, even after acquisition. But the company organizes its operations essentially into 6 major groups. And then new software companies that are acquired are essentially rolled into one of those groups. So in terms of the financial track record of this company, as I said, it's almost unparalleled in the stock market, one of the top performers for sure. So if we go back 10 years, compound annual growth in revenue was 21% per year. And then compound annual growth in normalized or adjusted EPS is about 25% per year. Growth in almost every year for adjusted EPS, and then good acceleration in that growth just recently in 2023. So here what I'm looking at is I can see that strong share price return that we've seen, 35% on average over 10 years, has been largely, although not entirely, driven by the growth in the earnings per share. So there has been some valuation expansion. The company has become more expensive over this period of time relative to the earnings, but most of that share price performance seems to be driven by the earnings per share growth. But how are things looking recently? Well, the company will be coming out with its Q4 2024 results in early March. But we can take a look at the Q3 2024, which were the last numbers that were released. So revenue, operating income looked pretty good. Revenue was up 19% to 3.4 billion, and then operating income up 16% to 518 million. EPS, on the other hand, was down. Normalized EPS was down about 12% to 918 per share. And then cash flow was about flat, just down slightly from 517 million to 513 million. Now, another thing that I did notice is that the balance sheet is becoming more leveraged. So if we look at the leverage ratio, net debt to EBITDA, as of the end of the third quarter, it was about 1.8 times. But they've been adding debt over the years. So if we look back just 3 years ago, their leverage ratio was 0.6 times. Now, 1.8 times for a software company, particularly considering that this is quite diversified, I don't think that that's an excessive leverage ratio. But I would say that it's in the range of being fully levered. So in terms of the balance sheet, no near-term concerns, but it is something that is worth monitoring, how high they want to push that leverage ratio and how dependent they are on using debt essentially to make acquisitions, because that's what I'm seeing here. Now, looking at the future growth expectations. So if we're looking at analysts, the midpoint of analyst estimates for this year, analysts are expecting 25% growth. Now, so that appears that the growth rate is being maintained into this year, assuming they hit the analyst expectations. This puts the price to earnings at about 65 times 2024 numbers, so say trailing earnings, and 50 times the expected 2025 numbers. So given the company's great track record, I can understand why it would trade at a premium. This is certainly what we would consider to be a premium valuation, especially for a company that is more focused on acquisition growth than organic growth. Typically, with a lot of the other software companies, we see most of the growth coming organically, which is preferential. Now, Constellation has such an incredible track record with what they're doing in terms of acquiring these businesses and growing their earnings per share from it, that I think that investors are really just looking at this as a part of the business and sustainable. But I certainly don't think that it's cheap at this level. So what is our take on the company? Well, we do think it's an incredible company, an amazing Canadian tech success story, outstanding track record of growth and profitability. However, the valuation, certainly not cheap. A lot of that, good news is factored into the price already. We are monitoring the increasing reliance on debt. That's something to watch. And then also potentially a slowdown in earnings growth. So analysts aren't expecting earnings to slow. We did see slowing in Q3, which doesn't necessarily mean anything. Year-to-date numbers were still strong, but that's certainly something to watch out for, is whether or not that earnings growth can be maintained as the company is obviously growing off of a larger base. But bottom line, really good company, solid company, but not something we're necessarily running out right now to recommend as an undervalued story, more fairly valued, with a good future.
Yeah, it's a company that's hard to bet against. I mean, obviously, I would never, but that's the thing. You got to stomach paying up, for the incredible track record.
Yeah, and it's not that valuation is ridiculous. It's not like we're looking at 100 times earnings or in the high, close to 100 times. But a lot of software companies do tend to trade at premium valuations. I think you said it as well. I wouldn't bet against it if somebody said I wanted to take a position just because I believe in the story and the CEO. I would definitely understand that. But just looking at the numbers, kind of on a price to value, it's, I'd say fairly valued.
I think it's one of those companies, a great long-term capital compounder that you could buy on pullbacks, like put it on your radar. Yeah. And if there's a general market downturn and the company comes down 10, 15%, like you look at a chart, at times it does, nothing is going wrong with the business, but you can get it when it's on sale. It's kind of like buying steak when it's on sale. That's what you're going to do with this business. Pretty cheesy, but yeah, like it's a good adage to live by with a company like this, for sure. All right, let's move on to our star and dog segment. We have a star and a dog, and I think Brett has both of them. He's doing double time this week or something.
So BigBear.ai Holdings, symbol BBAI on the New York Stock Exchange. The company offers AI solutions targeted at 3 segments: global supply chain and logistics, autonomous systems, and cybersecurity. BigBear.ai's customer, which include U.S. intelligence community, Department of Defense or DoD, and the U.S. federal government, as well as complex manufacturing and warehouse operators, distribution, healthcare, and life sciences, all rely on the BigBear's AI solutions to empower their leaders to decide on the best possible scenario by creating order from complex data sets, identifying blind spots, and building predictive outcomes. So their whole goal is really a predictive AI model for various industries. The stock has done, well, to say the least, phenomenal, as the stock has surged 304% over the past year, now trading at $8.61 a share and a $2.2 billion market cap. Over the past month, it's traded about 95% higher. So really, what has caused the stock to surge, especially recently? Well, the name should really give away part of it, at least, as it is a AI company, and it's just been such a prevalent trend over the past few years. And recently, with a post-US election buzz around it, it's really seen the entire space taken up. And that's probably part of what you're seeing here, at least from the stock market's interest. But more specifically, the company was recently awarded a contract with the Department of Defense to advance the company's Virtual Anticipation Network, or VANE, prototype. The stock surged a whopping 38% on the day of announcement, just massive surge on just that announcement. VANE's AI model's goal is to better assess news and media originating from countries that are potential foreign adversaries for national security usage. The solution looks to discover behaviors and relationships in potentially various news sources. It's not structured data without waiting for subject matter experts, so your foreign intelligence people, and then it provides scenario forecasting. That's the whole goal of that software, and that's really what really shot the stock right up, is this buzz around this specific contract. But now the question really is, does it actually have legs behind it? And this is the last quarter, it was Q3 in September, so there's obviously a bit of a time gap at this point. But can it switch to becoming a profitable company? As right now, it is just an unprofitable company. It lost $12 million on a revenue of $41.5 million in the last reported quarter. It is in a net debt position of $155 million, and it's been rapidly diluting shares over the years. And as well, top line, the revenue hasn't really been growing either. It's been choppy. So here you can see for the Q3, yes, it looks like it's doing great, but then on the trailing 9 months, it's effectively flat. And that's really been the theme of the company over the past nearly 4 years. So really what you want to be looking for is there actually sustained revenue growth off these contracts? You wouldn't see this until Q1, or if the company releases any preliminary results. But that's what you have to look at. And the company as well is trading at 12 times sales. Not cheap by any means. So you'd really need to see it grow into that valuation. So by no means does it fit Keystone's SCARP model. But if large government contracts and the likes do start to really come in and they do flow in at this rapid pace, which is what the bullish investors should at least expect at this valuation, it might enable profitability down the line, but we haven't seen that shift yet. But obviously there is a bit of time gap, and the stocks really surged recently on these expectations of some sort of future growth. But for now, BigBear.ai is our star of the week.
Yeah, I mean, it's speculative. Like, that's the thing. Like, obviously, I mean, you hit the nail on the head, and it's just, someone will say, we don't understand the technology, you know, this thing's going to be the next best thing. Maybe it is, you know, I hope, you know, for any shareholders that it is, you know, I hope that you make some good money there. But, you know, we just think that the risk outweighs the reward.
Yeah, and you went through the stat from Jenga, 90, you know, it's like 90% of these companies that actually go up 10x start with profitability. That's why we start there. We focus on that basket where 9 out of 10 are found, not the basket where 1 out of 10 are found. And in this case, this would be the 1 out of 10. So from where it is right now, we think that's not a smart bet on that company. Doesn't mean it can't be a successful business. It just, the data doesn't lie, and it tells you start with profitability, you're in a better position.
Yeah, it really comes down to risk management. Yes, people will say there's the 1 in 10 chance, but what are you going to choose, the 1 in 10 or the 9 in 10? I personally go with the 9 in 10.
Exactly. Yeah. Let's not overcomplicate it.
Exactly. Ray Dalio right there.
Yeah.
All right, so I'll
Bring it
move
full
on.
circle.
Yeah, full circle, exactly. So our dog of the week, Foraco International, symbol FAR or FAR on the TSX. It's a drilling services company operating in 22 countries across 5 continents. The company offers not only mineral drilling, but also water drilling, which is a bit different, and they have a 265 rig drill fleet. The stock, however, isn't doing so great. It's down 25% over the past year at $2 a share and 199 million market cap. But the shares fell 11% today after the company filed its Q4 earnings. So there's your reason behind the drop, but we'll look into their earnings a bit. And really, why did the market just react so negatively to this release? Because that is quite a steep fall for it. For Q4, revenue materially fell by 30% to 60.8 million from 86.6 million, which the company attributes to a poor junior mining financing market, which we can really echo from talking to other companies in the space. It's just been a really poor market for juniors, despite really, especially on the gold price. Gold price today, it was just below an all-time high. And yet these junior companies, they just cannot do financing at this time. So drilling services like Foraco just aren't seeing the demand from that junior space at this time. As well, though, the company has exited Russia, which took a hit. They had a negative impact from foreign exchange as well as contract timing. So really quite a few things really pressuring their revenue at this time. EBITDA fell to 10.4 million from 18.7 million, reducing EBITDA margins to 70.1% from 21.6%. However, if you do remove some one-time items in EBITDA, it does improve to 13.9 million, and the margin actually did improve on this adjusted basis to 22.9% as the company has lowered SG&A. So at least the company is trying to manage its operations when you are seeing weaker revenues. The company did have GAAP profitability of 3.4 cents, which was an improvement compared to the prior year's 2.4 cents, but the improvement was primarily a shift of non-operating financial costs. Otherwise, it would have been around flat. So just generally weaker financials. But another key non-financial metric I would like to highlight is rig utilization, which really drives home the point of the weaker results. Its rig utilization rate of only 35% compared to 55% in the prior year. While there are seasonal shifts amongst other factors, of course, the utilization rate really has just dropped over the past year every quarter. I think it was 40% in Q2 or Q3, 40% in Q2, and then I think 42, something like that in Q1. Then it just hasn't done great this year as far as the utilization rate goes. You've seen just lower demand, and that's really what management's attributing to. And you can see that be reflected in the rig utilization. If we look at the geographic revenue breakdown, as it does show the general weakness across the space, generally when you're looking at these, the reason why you geographically diversify is just to lower the risk, as when one goes up, the other might come down. Another, so you don't have as much volatility in your earnings. And what we can see here is for Q4, North America was down 10%, Asia Pacific was the bright spot, and it did grow by 38%. South America was down 69%, EMEA was down 59%. As I said before, the company did exit Russia, which is in their EMEA, but has also been impacted by the instability in West Africa, which we've heard elsewhere in the space. And then South America really has been the story of that poor junior mining market, and as well as some unusual delays as well. So right now you have 4 regions just doing poor, especially when you're looking at South America minus 69% and EMEA minus 59%. Now, of course, there was the impact of Russia there, which is very unusual, but just generally quite a poor overall market. And then the last thing I really want to highlight is the company doesn't have an extremely robust balance sheet, but it's not the worst either. It does have a net debt position of 61 million, which is an improvement over last year's 65 million net debt, as well as they did highlight some more higher than average working capital at the date. But when a slowdown does occur like you're seeing here, a robust balance sheet does insulate the company, but we just don't have that at this time. By no means it's an existential risk or anything like that, but it does reduce that financial flexibility. If other smaller miners in areas that they can't take advantage of other players' weakness, you can't buy them up if you don't have the balance sheet to back it up. And it just generally impairs the company's ability to navigate a turbulent market. So by no means is the company a complete write-off, but operationally it is weaker this time. The stock price has overall reflected it, and it does get our not-so-coveted award of the Dog of the Week.
That's a great summary. We do cover this segment as drillers are a great picks and shovels approach to playing a commodity boom. We've seen gold do tremendously well over the past year, for sure. And this is a great way to play that. You're not betting on one mining company; they get paid. It can be drilling for 50 companies, and they're getting paid regardless of whether that company hits gold, copper, or whatever. They get paid. The pick of the litter for us over the past year, and our clients already know, and we've already talked about this company, I think, on the podcast, is Geodrill. And one of the reasons we like it is the balance sheet, net cash. The growth in the business is there. The margins, the rig utilization are light years ahead of Foraco, for example. The profitability light years ahead. And it's no wonder that this share price, Geodrill over the past year, Foraco, down 20% or something like that.
25.
Geodrill's up 95%. So you can look at a sector and see, we can find some strength here. Not in the junior side, but the seniors and mid tiers are drilling at a good pace right now, and that's what Geodrill is servicing. And you can see, you got 95% gains here, 20% losses. It matters what stock you pick, even if you think that this is a good sector to be involved in. We also, interestingly enough, have just released on a coverage over this past month on another company in this segment, which is probably the cheapest and really growing earnings at a high rate. I cannot speak to that company because our clients are just, buying that as right now. They've just had we've just had the buy recommendation out for about a month now. But an interesting name in that space has better rig utilization as well. They'd like to increase their rig utilization, but it's certainly better than Foraco's, which is a paltry level, really. I'm going to use the word paltry twice in one episode. That's impressive. I think it was paltry. I don't know. All right.
Yeah.
Do we have anything further?
I just think the one thing we've talked a lot in the office just about, the weak junior market despite record gold prices. And I was saying to Ryan, do we ever see it come back? I mean, even just looking since 2008, and I'm quite young, still green in the market, so I can't go much further back than that, or I don't have the experience. But I feel like the junior funding has just gotten worse and worse and worse. Do we eventually see it come back? I don't know. You know, I know that a lot of people say that it will, but
yeah, I mean, typically
knows?
when you see gold on a rise, you saw junior miners follow at some point. I think this is for your speculative capital, and people have, for decades, they put monies, particularly in Canada, into this segment and have done nothing but lose money hand over fist year after year. You have these one-time spikes, but there's no way to value the junior. Most of the problem is too, there's a lot of unsavory characters in that space that are just raising money and putting it in their pockets to enrich themselves. It's a dirty little secret in the Canadian junior resource segment, and hopefully it's come home to roost and they can't do this, because it's really, to be honest, to be frank, it's disgusted me for years to watch these people, to go to conferences and see them bilking people out of money. So if many of these characters never get another dime from the Canadian investors, I would be happy. There are some great companies that are doing exploration work that needs to be done. It's just been a sector that's been tainted with a lot of unsavory characters and people who aren't really serious about exploration. They're just serious about lining their pockets. And if they don't get any more investor dollars, I'd be happy. There's some good companies that hopefully they get funded. But if they're serious about actually exploring and, bringing some actual mines online, that would be great. So
I think the one thing that you also said the other day to me, and I mean it makes sense, that speculative money is just chasing other spaces now. Brett went over BigBear.ai. Again, there's people are chasing and throwing money.
Well, at least that company has revenues. At least it has something that you can, and there's a hint of profitability. You're drilling a moose pasture in Saskatoon. Sorry, Brennan. If you're drilling on that thing, it's like, I'm in Vegas right now. I'd have better odds just going down there, throwing it on red or black. Honestly, I might have more fun. I don't even gamble. I'm in Vegas. I never gamble because I know the odds and it sucks. So it doesn't bring me any joy. I'd rather buy a great, small cap stock at a low valuation. That's not gambling. That's investing. It's easier. Yeah, and funny. But anyways, you'd be happier to do that than.
Last thing that I'll say too is just about a moose pasture in Saskatoon or in Saskatchewan. I've literally seen, like Ryan was saying, I have seen a CEO of one of these junior exploration companies put just under $1 million in his pocket, in pay in a year, drilling one of these moose pastures in, Saskatchewan. So it's just should you really be doing that? Probably not. Well, definitely not. But anyways, we've seen it time and time again. Moose pasture.
Yeah. Good companies can get founded. The rest of them can die like the sorry dogs they are. That's what I think about that sector. That's about it. I mean, there's so many good companies to put your money in and invest in, smaller, large, whatever, dividend payers. Put your money there. That's how you can grow it over time. And so I don't know if a lot of capital will flow back into the junior miners. Good companies in there that are maybe producing or have great management teams. I hope they get funded because we need discoveries. But there's a lot of fat that can be cut off there, and hopefully we don't see more Canadians losing money on some of these poor situations. So it kind of heartens me to see not a lot of capital flowing into those right now. There's a fool born every minute, so it could happen again. I've seen it over the years, so it could. But all right, let's end off this show. I've got to do some client calls from this room, which should be fun right now. All right, and if you are watching this on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.